He bought when others gasped, sold when they celebrated, and turned conventional wisdom inside out. In 1970, when seasoned professionals preached the gospel of buying low and selling high, a young systems analyst named Ed Seykota programmed his primitive computer to do precisely the opposite. His heretical approach would transform a modest $5,000 account into millions over the following decades, generating returns exceeding 250,000% and establishing one of trading's most extraordinary track records. The paradox seemed reckless until you understood the psychology. While value investors like Benjamin Graham built fortunes purchasing undervalued assets and waiting for rational corrections, Seykota observed something the textbooks missed entirely. Markets didn't move in neat, predictable arcs from cheap to fair value. Instead, they surged in persistent waves driven by human emotion, carrying prices far beyond what fundamental analysis could justify. When wheat or silver broke, through multi-week highs on expanding volume, his systems treated that surge not as a danger sign, but as proof of institutional force gathering momentum. He was among the first to let machines measure what eyes misread. On clattering mainframes, he coded simple rules, seeking not to predict the future, but to recognize when it arrived. His breakthrough insight emerged from studying commodity charts throughout the turbulent 1,970 seconds. The wildest, most uncomfortable trends were often the safest rides, provided you could accept the smallest losses when wrong. This discipline cut against human nature. Most traders tried to be heroes at bottoms, averaged down to cheap, and called tops with conviction. Seykota refused that role entirely. Small losses became tuition for staying in the arena long enough to catch the rare crescendos that repaid everything. His edge lived in quiet submission to evidence rather than fighting it, a posture both emotionally counterintuitive and mathematically consistent with the asymmetric nature of trending markets. On primitive terminals in the early 1,970 seconds, Ed Seykota programmed machines to recognize what human eyes consistently missed. Momentum wasn't magic waiting for inspiration to strike, it was measurable architecture. A systematic approach to detecting institutional force before retail crowds recognized the pattern. His breakthrough came from understanding that markets telegraph their intentions through three distinct signatures that unfold in sequence, each layer confirming what the previous had whispered. The foundation rested on breakout logic borrowed from Richard Donchian's channel methodology, but Seykota gave it sharper teeth. When a commodity or stock pierced its highest close over the past 20 to 55 trading sessions, his systems demanded proof of genuine conviction. Volume had to surge to at least 1.5 times its 20-day average. This wasn't about predicting future direction, but recognizing when real money, institutional money, had already begun moving with purpose rather than hope. Moving average alignment provided the second confirmation layer, a mathematical stack that ensured he rode with slope rather than against it. Seykota's computers traded only when the 20-day average climbed above the 50-day, which itself sat above the 200-day baseline. This cascading order filtered out the whipsaws that destroyed traders caught in sideways markets masquerading as trends, providing objective evidence of underlying directional strength that transcended short-term noise. The final filter concentrated capital on market leaders through relative strength ranking. His systems identified securities performing in the top decile over 3 to 6 month periods, understanding that strength begets strength in trending environments. He refused to waste ammunition on laggards, keeping pace when leaders demanded attention. This systematic architecture came alive in his legendary 1973 wheat trade. Seykota didn't buy wheat because fundamental analysis suggested it was cheap relative to historical norms. He entered precisely when it accelerated through resistance with expanding institutional participation, his three-layer system confirming that genuine force had gathered behind the move. The counterintuitive timing strategy separated him from conventional approaches. Rather than seeking bottoms or calling tops, his systems entered during acceleration phases when price moved with increasing velocity, turning the crowd's discomfort into mathematical advantage. Seykota's genius lay not in generating signals but in ruthlessly eliminating the wrong ones. He understood that markets offered an endless stream of apparent opportunities, like an ocean where whitecaps masquerade as waves but die before reaching shore. His three-screen filtering system transformed this chaos into clarity. discarding the 80% of breakouts that would have destroyed returns while concentrating firepower on setups with genuine institutional conviction behind them. Trend quality formed his foundation screen, demanding mathematical proof of directional persistence rather than accepting hopeful assumptions. His systems engaged only when the 50-day moving average climbed steadily upward, while price maintained its position above both the 50 and 200-day baselines. When the average directional index exceeded 25, it provided additional confirmation that real trending behavior had emerged, rather than sideways chop, masquerading as momentum. This screen eliminated the false breakouts that occurred during consolidation phases, ensuring capital deployed only when underlying directional force had established genuine persistence. The volatility sweet spot created his second filter, using average true range to measure market energy with surgical precision. Seykota avoided securities where 14-day ATR fell below 1% of price, recognizing insufficient power to generate meaningful moves. Conversely, when volatility exceeded 3% for equities, stops became too wide for practical position sizing, turning prudent risk management into accidental leverage. This mathematical framework distinguished genuine institutional accumulation from retail noise. Liquidity thresholds completed his filtering discipline. His systems insisted on minimum average daily dollar volumes of 20 to 50 million for stocks and front-month active contracts for futures, ensuring realistic fills and manageable slippage when deploying significant capital. His silver position in the late 1,970 seconds exemplified these filters working in perfect concert. Rather than speculating on fundamental narratives, Seykota's screens confirmed rising trend quality, optimal volatility characteristics, and sufficient liquidity depth. The filters transformed apparent speculation into systematic deployment, where mathematical edges aligned with market structure, creating the foundation for one of commodity trading's legendary victories. Execution transformed Seykota's theoretical framework into tangible wealth through mathematical discipline that eliminated human discretion at every critical juncture. His entry methodology refused to accommodate hope or anticipation, placing buy stops precisely one tick above defined breakout levels, where the market itself had to demonstrate conviction before receiving a single dollar of capital. When silver pierced its 55-day high with expanding volume, his systems triggered automatically, sizing each position through a rigid mathematical formula that divided acceptable risk by stop distance to determine exact share quantities. The arithmetic was unforgiving in its precision. Every trade risked exactly 0.5 to 1.5% of total equity, calculated by setting protective stops 2 to 3 times average true range below entry prices. This mathematical constraint meant that even a string of 10 consecutive losses could never threaten account survival, while a single explosive winner could transform modest risk into extraordinary returns. Position sizing became a mechanical exercise rather than an emotional gamble, removing the psychological pressure that destroyed traders who bet too much on individual outcomes. His pyramiding strategy violated conventional wisdom by adding exclusively to strength, never to weakness, with each additional unit deliberately smaller than the previous position. When silver advanced 1 to 2 average true range units while maintaining top-tier relative strength, Seykota would add 50 to 70% of his original position size at subsequent breakouts. This mathematical progression created a convex exposure curve that remained flat when wrong but expanded dramatically when right, concentrating maximum capital where momentum had proven itself through price action, rather than fundamental speculation. The legendary silver trade exemplified this systematic discipline in perfect operation, starting modestly when silver broke through $4 per ounce. Seykota pyramided methodically as the metal climbed toward $50, his position growing into multi-million-dollar exposure as each advance triggered predetermined addition rules. The progression looked deceptively simple from the outside but required absolute submission to mathematical logic over emotional impulse. Exit protocols completed his systematic framework through 3 mechanical triggers that removed paralysis from the most difficult trading decisions. Trailing stops followed price at 2 to 3 average true range distances from the highest close, automatically protecting open profits without premature exits during normal volatility. Moving average violations provided secondary confirmation when closes fell below the 50-day baseline, while breakout in reverse signals activated when securities violated their 20-day lows, indicating that underlying momentum structure had fundamentally shifted. This mathematical foundation created asymmetric return profiles, where a handful of massive winners generating 10, 20, or 50 times returns easily offset dozens of small losses, compounding wealth exponentially through expectancy rather than prediction accuracy. The psychological warfare began the moment reality contradicted hope, transforming mathematical confidence into visceral doubt when equity curves dropped 30 to 40% below their peaks. Seykota treated these drawdowns as information rather than indictment, understanding that pain arrived as data in trending systems, designed to endure many small cuts while waiting for the few crescendos that would repay all tuition with extraordinary interest. The 1,970 seconds delivered unprecedented volatility through oil crises, currency devaluations, and inflation spikes that shattered conventional approaches. Yet his momentum methodology extracted profits from chaos itself by embracing rather than fighting market psychology. His philosophical framework penetrated deeper than technical analysis or risk management protocols. Everyone receives exactly what they unconsciously seek from markets, meaning trading outcomes reflect internal psychological states more accurately than external conditions. This insight transformed normal system behavior from personal failure into mathematical inevitability, removing the emotional charge that destroyed traders who interpreted temporary drawdowns as evidence of fundamental flaws in their approach. Pre-commitment formed the foundation of his psychological discipline. Before entering any position, Seykota predetermined acceptable risk levels and committed to honoring stops regardless of subsequent emotional turmoil. He tracked process metrics instead of profit fluctuations, measuring adherence to systematic rules rather than short-term performance variations. Scheduled reviews replaced reactive adjustments, creating structured intervals for objective assessment, while preventing emotional interference during active trading periods. The mathematical reality underlying his resilience was elegant in its harshness, even with win rates hovering around 35%, where winners averaged 2.5 times risk while losers cost exactly 1 unit. Expectancy remained positive at approximately 0.225 times risk per trade. This arithmetic worked only if small losses never mutated into catastrophic ones through hope or stubbornness, demanding absolute submission to stop-loss discipline that eliminated the fatal human urge to give positions more room when wrong. Seykota's revolutionary methodology lives on wherever traders transform market chaos into systematic opportunity, creating an unbroken lineage that flows from Donchian's original channels through his pioneering computer programs to the legendary turtle traders and ultimately to the sophisticated algorithmic systems managing billions in contemporary markets. This quiet thread of mathematical logic has survived decades of market evolution because it addresses the fundamental constant in all financial systems: human psychology expressing itself through price action, creating persistent inefficiencies that systematic approaches can harvest regardless of technological advancement or market structure changes. The daily discipline synthesizes his breakthrough insights into actionable routine that modern practitioners execute with mechanical precision. Each morning begins with systematic scanning for securities piercing 20 to 55-day highs, confirming the critical alignment, where short-term averages climb above intermediate and long-term baselines, then ranking candidates by 3 to 6 month relative strength to identify genuine leaders rather than laggards keeping pace. Liquidity verification ensures realistic execution before average true range calculations determine exact position sizes and stop placement, removing emotional interference from the most critical decisions, where mathematical edges must deploy consistently regardless of current market narratives or psychological pressure. Contemporary markets present challenges Seykota never encountered during his pioneering era, yet his core framework adapts rather than breaks under new conditions. Algorithmic competition has compressed some traditional trend persistence, while creating fresh inefficiencies across different time frames and asset classes, demanding more sophisticated filtering to distinguish genuine institutional accumulation from high-frequency noise. 24-hour global markets require modified approaches to classical breakout logic, while increased market efficiency pushes systematic traders toward longer time frames or alternative assets, where human psychology still dominates algorithmic optimization. The mathematics remain constant even as the implementation evolves, Weekly discipline reinforces systematic execution through structured review cycles that prevent emotional drift from proven methodology. Open positions undergo evaluation for pyramiding eligibility, allowing traders to add systematically to strength as trends confirm themselves through continued price advancement and relative performance leadership. Trailing stops adjust mechanically to protect accumulated profits, while laggards violating initial trend criteria face ruthless elimination, preventing small losses from metastasizing into account-threatening disasters through hope or stubbornness. Monthly and quarterly assessments provide deeper analytical layers, where performance attribution reveals which market sectors and timeframes generate consistent profits. Parameter validation ensures system robustness rather than curve-fitted optimization. And correlation analysis prevents concentrated exposure from transforming diversified systematic trading into inadvertent sector speculation. This hierarchical structure creates multiple feedback loops that maintain systematic integrity across changing market regimes. The ultimate contribution transcends technical methodology to encompass systematic thinking as a comprehensive life philosophy. Seykota demonstrated that sustainable success emerges not from predicting unpredictable future market direction, but from developing disciplined frameworks that respond appropriately to actual price behavior through mathematical consistency and psychological mastery. This approach creates edges in any environment characterized by uncertainty and asymmetric outcomes, whether financial markets or broader decision-making contexts, where systematic analysis outperforms emotional reaction. His mathematical foundation continues generating wealth for practitioners who master the counterintuitive discipline of buying strength while selling weakness, accepting small losses as necessary tuition for capturing rare exponential winners that transform modest accounts into generational wealth. The framework looks deceptively simple from outside observation, yet demands absolute submission to systematic logic over human impulse, creating convex exposure curves that remain flat when wrong, but expand dramatically when market waves gather genuine momentum. This asymmetric architecture, engineered rather than hoped for, represents Seykota's enduring gift to anyone willing to ride market currents with systematic rules rather than fighting against forces far larger than individual opinion or prediction.